Hey cats, this is Rich. Oh my goodness. Sometimes people just like to stir the pot. Sometimes it's the president. Last week, he tweeted or truth socialed, I'm not sure what you call these things anymore, X'd an announcement that he's instructing the FHFA and Fannie Mae and Freddie Mac with their $200 billion cash war chest to start buying mortgage-backed securities. Man, that sounds like a pretty cool thing. What can happen is when they start buying mortgage-backed securities, that is decreasing the supply of mortgage-backed securities, increasing the price. Therefore, it could potentially drop the rate of mortgages. Because there's less inventory for mortgages, people are willing to pay more. The question is, though, is this going to last for a long time, or is it a Band-Aid? You see, there's a few other things that happened as well. The first thing that happened is the day before, he said, we're going to have to increase our defense spending by 50%, bring the budget to 1.5 trillion. Well, how do you do that? We don't have the money sitting around. What we have to do is we have to issue more debt. So on one hand, he's issuing more debt. On the other hand, he's buying mortgage-backed securities. So when we're doing something like that, it's sort of like a seesaw. It's a teeter-totter. And the problem with this is we don't exactly know how it's going to play out. The other part is this. Is the FHFA's purchases of mortgage-backed securities going to slow down the Fed doing their quantitative easing and buying mortgage-backed securities? Really, it's a great soundbite. It's going to help interest rates. If you're looking at refinancing, this is probably going to be the time to do it. It's not going to last very long. What would really help out a lot more is if the loan level price adjustments, also known as LLPAs, if the government were to work with FHFA, who is the regulator for Fannie Mae and Freddie Mac, and drop the loan level price adjustments, that would really help housing affordability, and it would be a more long-term fix. So we're grateful right now. This is going to help housing affordability just a little bit, but I don't think it's a long-term panacea that we're looking at. Do not be looking for 2 and 3% rates. This might be good for 1/4%. I don't know. I haven't modeled it out, but it is big news, and we saw the markets react pretty drastically after the announcement on Thursday, and Friday they've been all over the place. The other thing that happened was we had the Bureau of Labor Statistics. They released their report for December, and it showed that there were 50,000 jobs created. This is less than the 60 anticipated. However, because of that, what it's showing is the unemployment number edged down slightly. Well, if the unemployment number edged down slightly, the president has just added all of this potential liquidity to the market. My thought is the Fed will likely pause on any potential January rate cuts. So there's just so much going on in the market right now. We can't figure out what's going to happen. I just hope I don't go splat and hit my head on the teeter-totter because, somebody's doing it a little too violently. Let's take a look at what's going on in the real estate market in Houston. So the last week of the year, once again, last week of the year, December 30th to the 5th. December 30th was a Wednesday, of course. Thursday, Friday, Saturday, Sunday, holidays. A lot of people, Monday and Tuesday were holidays for kids too. Not a whole lot of activity. Year over year, down about 5.6% on listings and pending listings. A lot more homes went off the market, about 18%. Closings, though, were up. A lot of people were working hard to get those closings in on the last day of the year and the first couple days of this year. So we see that people are still buying homes and showings are up. There are more people looking at houses right now than there were at this time last year. I think that we're in a pretty good spot because with the affordability coming down, we talked about what the president's doing to help it. With the increase in volume and with the fact that people have lived with their mortgages so long, they're kind of getting sick of them. I think we're going to see a lot more people buying and selling homes this year, moving out of wrong-sized homes or the wrong home for them and giving up their 2 or 3% mortgages. This is a great opportunity because we do have more inventory out there and you're able to negotiate a little bit better. If we take a look at the December fresh report, this is also done by Houston Association of Realtors. This is the first real estate snapshot of Houston. Listings up, new listings up. List price was flat for December. And on the rental market, we saw that active and new listings went up as well. There was a little bit of downward pressure on rents, but nothing that's not seasonal and nothing that I really think is going to hurt the rental market. I think that it's a pretty steady place. One other thing to think about right now is housing starts. Housing starts and permits fell in October to an annualized rate of about 1.25 million. Permits also fell to an annual rate of 1.41 million. Now, housing completions, they did increase. So what does that tell us? Well, the builders are working their way through their pipeline, but they're not necessarily as bullish because there is more inventory. The other big thing that came out from President Trump was he said that he is going to work to stop institutional investors like Blackstone, not BlackRock, Blackstone. I know they sound the same. They're very different. From owning way the heck too many residential properties. Now, I'm a little bit concerned about this. There's some really good things that can happen when these institutional investors are allowed to buy single family homes. Like what? Well, let's say, God forbid, 2008, a builder went out of business. They had a bunch of unfinished inventory there. They had houses that were shells. If an institutional investor could not come in and purchase these homes, they would just sit there and rot and devalue the entire neighborhood. That would also hurt our housing supply. Also, what are they going to determine is a corporate investor? How many homes makes it an institutional investor? If you're, a family and you've got 10 houses between you, is that too many? There's just too many questions about this, and I don't understand how it's going to be implemented. So these are the different pressures that the market is feeling right now. This last week has been extremely eventful. We do see oil prices coming down. I believe that we think that the oil from Venezuela is going to be more released to the world now. So that's a good thing for a bit. But oil prices are also getting so low in Houston that some of the major oil and gas companies are starting to warn of pending layoffs. Overall, our market's pretty good. We're in equilibrium, but we need to be a little bit cautious. Now, I've got a webinar coming up on the 28th of January. This is for people who are self-employed that want to buy homes. And you have to see this webinar before you file your tax returns this year. If you're wanting to purchase a house and you're self-employed, there's no need to forego all those write-offs and pay the IRS way the heck too much, because seriously, what are they going to do with the money? Let's talk about how we can keep the money in your accounts. Let's talk about how we can use that money to help you purchase your own home. So we'll see you at 6 p.m. on January 28th. This is Rich with Abide Home Loans. Have a great week.